Friday and Thursday, gold and silver have been in pretty close to a free fall right now. This is the silver chart right here I'm looking at. And let me just highlight the last 2 days. Okay, the stock, it's been around, the silver's been around, whoops, sorry, about $29 a share, something like that. Or, I mean, actually commodity itself. And you can see here are the last 2 days. That's a pretty big move in 2 days. Silver was it was right around $28 an ounce, $29 an ounce for many, many days. Each one of these candles is a day. And look at the last 2 days. Dropped from 28 as low as 23. That's 2 days. So what do we know about commodities? They can be very volatile. They can be very volatile. Gold today, let's take a look at what gold is doing. I'll put the gold map in there, or excuse me, chart. Let's take a look at gold. Here's gold's move from $1,584 down to hit as low as $1,385 this afternoon. Now it's actually coming back up a little bit. So again, pretty big move for the commodities. So again, that's one of the nice features of thinkorswim software. We've got the charting capabilities to look at days, zoom in on any part of a chart, and really zoom in on numbers and things. All right, well, we're getting pretty close to 7:30 starting time, so I think I will get started. Did that other mic work or no? He's working on it. Okay. So I'll just use this for the time being. That's fine. All righty. Well, let's get started a little bit. My name is Scott Connor. Welcome, everybody. Thanks for coming back. I know I see many faces from Saturday and Sunday at the event. Thanks for coming back again. We will talk tonight a little bit about thinkorswim. I will reiterate the special offer that thinkorswim provided for everyone anyone who attended the SIAS, or of course anybody attending tonight. We had lots of questions on Saturday and Sunday, and there was a little bit of confusion about what thinkorswim does and the special offer that thinkorswim had for everyone who attended either tonight or the Saturday and Sunday Investment Week seminar. Okay. But at any rate, let's. So I'll go over that. Let's start first off with a little piece of paper. For those of you who didn't pick this up at our booth over the weekend, we have some out here tonight. And all this is it's a little voucher that we passed out to everyone at the event and tonight that tells you the special discount you will have if you do open an account at thinkorswim as a result of visiting over the weekend or tonight. And the way that works, I'll just give you a real quick idea what that is. If you open a funded account, now a funded account means a real account. We give you the demo account for free, that's fine. You just register with thinkorswim, you have our demo account, no problem. If you open a funded account, where you actually deposit $3,500 in US dollars, then you get your first 10 trades free. Now that's up to a $250 value. That's one thing you get. The second thing you get is that we lower your options commission rate from our normal rate, which is $2.95. We lower that down to $1.50. Oh, great. Thank you. Test. Oh, good. So there was a little bit of confusion about that, and I had many questions. So that if you do fund an account, you have until the end of May. There's no rush. So we're not rushing everybody to say you must open your account. You have plenty of time to do it. What I recommend is getting a username and password. Tonight, if you're interested in that, or getting a username and password and using our demo software for free, then just fill one of these out at the booth in front, put your name on the back with your email address, and then we'll contact you in the next day or two and tell you how to proceed. All right? But the important thing is we'll have your name on the list so that when and if you open an account, you'll be set on the $1.50 rate as opposed to the $2.95 rate for options. Okay? Very important. All right? So make sure you fill one of these out if you haven't, or if you did not at the seminar, and we'll have it all set for you there. The second thing is, many people ask me, they say, well, Scott, if I do open an account at thinkorswim, what are some of the advantages that thinkorswim has over the other brokers? Well, the first and foremost is that we are registered with the MAS. Okay, we're licensed to be here. There are other brokers that will let you trade U.S. products on a U.S. exchange, but they're not even here. They're in Hong Kong or wherever else it is, and they're not licensed by the MAS. Okay, we are. Everyone who works at thinkorswim is an appointed rep registered and licensed with the MAS, which is very important for you. Second thing is, in addition to what we'll be talking about tonight, I do see some faces that come to my classes, but I hold classes as the Director of Education at Thinkorswim at SMU on Tuesday and Thursday nights. Now, these classes, if you will, or demos, are in 3 levels. So if this is new to you, let me take you to the home page and show you how you can register for these. I'm going to the Thinkorswim home page. This is our home page. If you scroll down just a little bit lower, you'll see just below the green pig here that says Register for Demonstrations. Now, if you just click on that, it will take you to the registration page, and you'll see the 3 different levels of demos. The first demo we call Basic, and on the Basic demo, let me scroll down and show you exactly what I'm talking about. This is the registration page. Let me scroll down. You'll see the first demo right here. This is the Basic demo. You can see the Basic demo talks about how to use our software. It's a 2-hour class. The next one's April 30th, 7 to 9 at SMU. Learn how to use the software. Okay, we really focus on how to navigate the platform, how to use, how to enter orders, et cetera, et cetera. Great starting point if you're new to Thinkorswim. After that, we have the intermediate demo. Now, the intermediate demo starts getting down a little bit deeper into how to use the software. For example, how do you best use the software to help you execute trades the best possible way? In other words, how do you take advantage of all our software, our dynamic pricing, our level 2 quotes, all the things that we provide free, absolutely free to you. How do you use them so that you can better execute your trades? So what I do is I take my 25 years on an exchange, standing on an exchange trading pit, and trading hundreds of thousands of options contracts a year, and I'll show you and share with you what I learned about execution and help you get better fills. That's important. We'll also, in this class, we'll start introducing different option strategies. Now, I cannot recommend what you should buy and what you should sell and when you should do it. That's up to you. What I do is I show what I learned as a professional trader, what are the do's and don'ts, and what are the pitfalls you must avoid. Now, yesterday, for those who attended my session, I talked about the 3 criteria that are important whenever you consider an options trade, no matter what the strategy is. We talked about one of those, if you remember, was defined risk. Well, I bet a lot of people that have gold and silver positions wish they had defined risk right now. If they didn't, it's probably a little bit painful right now for them. Okay? So I always emphasize those criteria. We talk about different option strategies and how to execute them on the Thinkorswim software. Okay? Now, I cannot make recommendations about what to do, but in the classes, we have fun. We don't just say, okay, here's how you use this, here's how you do that. We open up the demo accounts, because everyone here that registers with Thinkorswim has the demo account for free. And what we do is we actually put positions on in the paper money account or the demo account. And then we have fun as a group. We watch them. What happens as we get closer to expiration? Because remember, options have a lifespan. Now, we put a position on that we'll take it close all the way to expiration, and we'll watch and see what happened, and we'll learn. So you actually hands-on will be putting on small trades. We have a couple trades on right now for my other intermediate and advanced classes. Okay? And again, paper money, but it treats it just the same. So when you are on our demo account, everything that happens will be just like it happens in your real funded account. All right? And that's the beauty of it. So everything you're learning on the demo accounts, and as we go through them, it will be just the same thing on live account. Everything looks the same. And then the final is the advanced demo. Now, advanced demo, that's the only class that has a prerequisite. I ask that you have at least 4 to 6 months experience trading options and stocks and ETFs on the Thinkorswim software. Okay? So we don't spend a lot of time on the basics of how to use the software. We go into the dynamic parts of the software, what we call the Analyze tab, the way we can analyze trades and look at their risk profiles and hedge positions. We talk about how you do that with the Thinkorswim software. We also look at, well, what if I had a whole portfolio of stocks and counters and ETFs and options positions? How could I look at that whole position with all sorts of different underlyings and make one trade to hedge that entire portfolio? That's what we learned to do in that class, and how to use the Thinkorswim software to do that. Okay? That's called beta weighting. So we'll take everything you have, beta weight it to the S&P 500. Now we have one product we can use to hedge our whole portfolio. So that's the kind of thing that we do on the demos. I teach them all. And one word to the wise, when you're starting to come to these classes, particularly the intermediate and advanced, they fill up very fast. So you will see on the website the day that the registration begins. And just a little hint to everybody, don't wait a week. Okay? If you see a date that fits with your schedule and you're interested in coming, try to sign up within the first 2 or 3 days after that date becomes available. If you come back a week later, it will say, sorry, let's see, I'll show you right now. This is live on the software. It will say this, sorry, registration for this class is full. All right? But you have 3 or 4 days when they first become available, okay? The basic demo is actually open still. So if anybody's interested in that, let me make sure that I'm correct on that. Yes, basic demo is still available. That's April 30th, 7 to 9 at SMU. There's probably still a few spots left in that class for those who are just learning about Thinkorswim. Well, that's pretty much it that I want to talk about, Thinkorswim and our homepage, and also the special offer that we have. So if you have any more questions about that, please see me after we wrap up, and I'll go over that with you. Put thinkorswim.com.sg, put that in your bookmark so you know exactly where to go and how to get started. For those who did not get a chance to register with us and you'd like to get started on the Thinkorswim software, on the home page, I'll show you this. It's very simple. You can do this in probably a minute and a half. Click right here where it says open an account. Now when you click here, you're not really going to open an account. You're just going to register. Now you certainly could go ahead and open the account and finish the paperwork and get it all started. That's fine. But this is the first page that if you fill this out, establish a username and a password right here, and at the very bottom, make sure you choose, how did you hear about Thinkorswim? Choose right here, Trade Show, and then also click here where it says Singapore Expo. Click Register, and you're done. Now, it will ask you more questions because it wants you to open an account. It wants you to fund a live account. But if you stop right there when you click Register, now you have a username and password. Now you can download our software and have our free demo account, and you're all set. Okay? If you want to fund your account and take advantage of the 10 free trades, you have until May 31st to do that. So there's plenty of time. So if you'd like to just get started, try our software. Once you're registered, you can come to the classes as well. They're free. The software is free. Using the demo platform is free. You will have the demo platform for 6 months unless you open a real account. Now when you open a real account, you will always keep your paper money or demo account as well. Okay? All right, well enough of that. Let's get on to what the reason we're all here. We want to learn more about options. So in the class, I spent some time focusing on the 3 criteria involved with any options trade. And I think many of you were already at that class. But we talked about 3 things. And just a quick review. Number 1 is defined risk, which means no matter what kind of trade we make, we would like to know exactly how much we can make and exactly how much we can lose, no matter what the stock does. Does that make sense? Because I tried to share with everybody what I learned as a professional trader for 30 years is that people who got in trouble and were forced to get out of positions and realize large losses, it's because they started off with a position that had unlimited potential in loss. Now they didn't have to do that, they chose to do that, okay? So there are ways with options to always limit that loss, always know exactly how much you can make or lose, okay? That's one of the big differences between stock and options, okay? When we buy a stock, we discussed when we buy a stock, no matter what anybody tells you, this is one thing I learned as a professional trader, no matter what anybody tells you, stock can only do 2 things once you buy it. It can go up and you make money, or it can go down and you lose money. That's it. Heads or tails. Now, of course, there's people everywhere all over the world that are going to tell you, well, they know that stock is going higher, and you must buy this stock because it is going higher. And you can just say to them, well, how do you know? Prove, show me that you know the stock's going higher. They don't. They can't. The fact is, we don't know where the stock is going to be tomorrow. And if anyone ever tries to tell you they do, you turn and you don't walk away, you run for the door. That's what I learned as a professional trader. Because if anybody in the world really did know where the stock is going to be tomorrow, they wouldn't be here telling you about it. They'd be sitting at home on their Thinkorswim software just trading away. Okay? So that's number 1. Second thing about options. What else did we discuss? Does anybody remember? Defined risk, what else? What was that? High probability trades. HPT are the symbols. You'll hear me say that a lot, HPT, high probability trading. So what's the other thing that options offer us beyond stocks and buying stocks and futures and other things like that that have that up or down possibility? Well, options allow you to choose what kind of probability you would like. Now, when we buy a stock, we can't choose the probability. We just got done saying that we either goes up or down, and there's a 50-50 chance. There's nothing you can do to change that. The laws of probability are fixed. All right? Now, we hope we're right and the stock goes up and all the research we've done and et cetera, will maybe improve our odds of 50-50. But the fact is, it's still 50-50. Now, you can start an options trade, on the other hand, and pick the probability. And I'm going to show you on our software exactly how that works. We call that the probability of an option expiring in the money. Now, that probably doesn't mean a lot to everyone here, but I'll show you exactly what that means. You'll have a much clearer idea of why you can choose your probability. Now, one thing you have to keep in mind about probability is that there's always a risk-reward with everything we do. Right? What happens when you buy a stock? What's the risk? Well, the stock could lose all its value. What's the reward? Well, the stock could go much, much higher. The stock could get taken over by another company at a much higher price. In those cases, you profit. The stock does terribly and loses money, then it goes down and you lose. Okay, so we know the possible outcomes of doing that. Okay, what we're going to look at is using options to say, well, if we have an opinion about a stock, whether we think that stock is going up or whether we think in the near term the stock is going down or just going to stay in a range, there are options trades that you can put on that will profit in all three of those different scenarios with a high degree of probability, higher than a 50-50. So that's one of the things we want to focus on tonight. How do we know how that works? The last thing was also time decay, and we'll spend a little bit about that because we'll talk about an example of covered calls. It's a covered call strategy. So tonight we'll look at two strategies, fairly simple strategies in terms of options trading, because I think that would be a good starting point for everybody here. And when we look at these two strategies, it'll give you some insight as to how options work. All right, so I want everyone to leave here tonight being very comfortable with the concept of covered calls and also with the concept of selling puts to buy stock at a discount. So those are two different strategies we'll look at tonight. And that's pretty much it. I don't want to go further than that. In the classes, intermediate and advanced, we look at the software and look at those kinds of strategies and how you implement them as well. All right? So that's the focus for tonight on options, covered call strategy, and selling puts to buy stock at a discount, okay, and using high probability. So let's take a quick look at the thinkorswim software. Many of you are familiar, obviously. This is the left-hand side. I'm looking at different watch lists here and here. On the right portion, we have a series of tabs across the top. We are going to focus tonight on the Trade tab. Monitor tab is where I go to look at my positions. Trade tab is where I go to trade. I can trade all products. I can trade Forex, futures, active trader. These are different things I can trade on the demo account. What can I trade on the thinkorswim software? Well, I can trade stocks, options on stocks, exchange-traded funds, futures, options on futures, but not Forex yet. Now, we can trade Forex on the demo account because our software is all set up to do it. We just haven't been approved by the MAS yet. So we're waiting for that. And once that happens, then you'll be able to trade Forex on our live platform as well. Okay, but we'll already let you start practicing if that's what you'd like to, if that's one of your interests, using the Forex on the demo account. All right, so it's already there. The software is already there for you. Okay, so just to make sure there's no confusion, many people asked me yesterday, they said, well, you just trade options, right? And I said, no. Basically anything that trades on a U.S. exchange, you can trade on thinkorswim. Stocks, futures, options, et cetera, et cetera. And then the next question I got from a lot of people yesterday, well, what about foreign stocks? Well, a lot of the foreign stocks that are the larger stocks that are, for me, much more interesting to trade because they're much more liquid. I have much better chance of getting in and out of positions without having to pay a lot. That's important to me and should be to you as well. Many of those stocks are available on thinkorswim. I think yesterday we used the example Baidu, right? A very large company in China. That trades probably better on thinkorswim than it does, or in the U.S. exchanges, than it does anywhere else. So the answer is yes, there are many foreign stocks. Now, what about the SGX penny stocks? The answer is no. Not right now. We're looking at that, maybe in the near future. But you want to know something? And the reason I'm not interested in trading those stocks? Well, there's two reasons. And I've been doing this 30 years. Number one, I find that those stocks trading under $1 are very manipulable, if that's a word. Okay? There's enough people can make those stocks move up and down just with their order flow. Number two, if an option's trading under $1, a counter's trading, there are no options. Okay? And then if there's no options, well, I'm not really interested because now I can't pick my probability anymore. Now I'm back to I'm forced to use a 50-50 probability again. So that's why it's not interesting to me, and that's probably one of the reasons that Thinkorswim has not been more aggressive about getting those started, but we will. We will. It's just a matter of time. But you'll have those as well. Okay. Well, let's get started. I'm on the trade tab. So how do I make my, how do I learn about options and where do I see options pricing? Well, what were we using yesterday? Everybody was asking me about Apple. Let's punch that in, AAPL. I put it in the little box right here. Now just hit enter. And once I hit enter, I can see the last price for the stock right here, $429.80. I can see the current bid and the current ask, $426.70 and $426.80. That's the bid and the ask. So these are the people trying to buy. These are the people trying to sell. Now what just appeared here are all the options. These are all the options. Now to make this portion a little bit larger, I'm going to hide the left side bar. And I do that by just clicking here. You can see, and now I'm just looking at the options page. I can bring it back by clicking there again. Let's leave it out for the minute so we can just look at the trade tab and look at the Apple options chain, which is this area down here, because we want to get a good idea of what options are. That's one of my goals tonight, is that you will learn tonight what an option is and feel comfortable with it and learn something about two different strategies. All right? So here's the stock itself. If you'd like to see a little bit more about the stock, just click on the triangle here and it will tell you the yield of Apple, the price to earnings ratio, the earnings per share, the dividend date, et cetera, et cetera. There's a lot of information here. If you want to know more fundamentals about the company, we have a little button here called Company Profile. I can click on that. Now it loads data here for me. And this is actually a very interesting little tool. It shows you the breakdown of all of Apple's percentage of market cap, where their gains come from. So you can see the iPhone right here is 51% of Apple's sales. That's a tremendous amount, obviously. iPad, Macintosh, other things. If I'd like to say, well, listen, I've done some research. I think iPhone sales are going to drop for whatever reason. How could I make my prediction and see what that does to the stock price? Well, then just click on it and say, listen, iPhone pricing. Let's say I think that they won't be able to keep selling iPhones for $700. They're going to have to bring that down. Well, just click here. Start bringing the price of what they sell phones at. Now, as soon as you do that, if you had to lower phones down to $500, what would that do to their stock price and their earnings? You can see right there. It shows you. Okay? Very interesting. What if sales change in mobile phones, et cetera, et cetera? Or the gross profit margin changes in iPhone. So it's just a tremendous little tool if you want to really change things around. Or what if they get better? Do this and look what happens to the stock price estimate. So it's a very, very interesting tool. But we're going to focus on options. So you see the option chain right here. And options are all listed here below. Now there's lots of different options. There's something brand new called mini options. We'll talk about that in a minute. But right now I just want to focus on the standard options. So let's go out a few days until these options expire. Now let's pick not 4 days, not 11. Let's pick something out here. 32 days till expiration. Perfect. So we will look at the May of 2013 options that expire in 32 days. Those are the ones we're going to look at. Now to look at those, we'll click on the arrow right next to May 13 and let's scroll down and take a look at what we're looking at. There we go. The May options. Now we have calls on the left and puts on the right. Tonight, for the first example, we're just going to focus, actually, no, we're going to focus on the puts. We'll start off with the puts. Now, first of all, what is an option? What is an option? That's the easy part, and we discussed that a little bit in the seminar on Saturday, for those who were there. And options, actually, the concept of an option is very simple. It's very simple. I mean, when I first started, it seemed kind of complicated to me. The whole idea was a little bit scary because it was new, okay? But in America, or in the U.S. and many other countries, it's the fastest growing segment of our industry and has been for probably the last 10 or 15 years because people are learning about that finally. It wasn't until the mid-90s that people even heard of an option before. I started trading on the exchange in 1980, and it wasn't until like 1990, 95 when it really became popular and people started learning about them and what they could do and the choices that it provided them in terms of trading and probability. So what is an option? Well, again, let's go over our example real quick. An option is something similar to a coupon that you can use in the store to buy something at a special price or a fixed price. Let's just say a fixed price. So our example, I think we used the other, if you had a coupon that said, okay, this coupon allows you to buy one, it doesn't matter what it is, one can of Coke, okay, for $1.50. All right, that's your coupon. Now, what if you went to the store with your coupon and Coke had risen to $3 or $4? Could you still give them your coupon and say, listen, no, I get to buy it at $1.50. Is that true or not? Yes, sure, because that's what your coupon says. So it doesn't care what the current price of Coke is. Your coupon says you get to buy one can for $1.50. Well, what if you brought that coupon in after it expired? They won't honor it. It's not good anymore. Now you have to pay the normal price. So option, very simple. Option is just a coupon that says you have the right to buy 100 shares. Again, I'll repeat that, 100 shares at a fixed price until the coupon expires. That's it. That's it. Now we're talking about call options. That's it. So the concept is really, really simple. The difference between a coupon in the store and the coupon with a stock is that the coupon for a stock, you need to buy it first. It's not free. You can't just clip it out of a paper or someone hands it to you free. You buy them and sell them because their value goes up and down with the stock. Now that should make perfect sense because I think we were talking about Baidu. So let's say I had a coupon that says you get to buy 100 shares of Baidu at $90 a share for the next 32 days. Now, okay, great. Now I have to pay something for that. It's not going to be free. I might have to pay $1 or $1.50 a share for that right. Let's say I Baidu in the next 30 days, sure enough, it goes up to 95 or 100. Do I still get to buy it at 90? Sure, that's what your coupon says. You get to buy it at 90. Well, great, then I'll buy it at 90 and I'll sell it at 100 and I just made $10 a share. And I never even bought the stock. Now, I don't make 10 because at 10, you remember how much I had to buy the option first, right? So I make $10 minus whatever I had to pay for the option. Maybe in this case, $1.50 or something like that. But you can see the gains are tremendous compared, in that case, of how much I had to pay for an option. Now, that's a pretty big move for a stock, obviously, in 1 month. Stocks typically do not move that much in 1 month. But every time a stock moves, we can tell and calculate exactly how much the value of your option will move up or down with the stock, depending which way it goes. Now, the big takeaway was, well, what else is the advantage of options and why did they become so popular? Well, it's because they allow people to start taking opinions with high probability for a much lower price than actually buying or selling the stock. So let's go to the example, back to our example of 100 Baidu. Let's repeat this one more time. If I buy 100 shares of Baidu at $90 a share, I need, how much is it? $9,000. 100 times 90, 9,000. If I buy the option that lets me buy the same stock, same 100 shares, same price, only it expires after 35 days, how much do I have to pay for that option? Well, we said about $2. Let's say $2. Well, that's $2 times 100. That's $200. So this bet to buy stock at 90 is $200. That's how much money I put on the table. This one, to buy the real stock itself, I had to put $9,000 on the table. Now, who's controlling more stock? The person who actually outright bought the stock or the person who has a right to own 100 shares? Who's controlling more stock? No, it's exactly the same. If Baidu goes to $100 a share, the person who bought the stock, he bought it at 90, he can sell it at 100. Great, he makes $10 a share. What about the person who bought the call? Well, he still has the right to buy stock at 90, and he can sell it at 100 too, and he makes $10. Only he had to pay $2 for his option, so his net is only $8. But he only put $200 on the table to make $800. This person put $9,000 on the table to make $1,000. Okay? So when you look at the rate of return on the two investments, that's why they gain so much popularity. We call that leverage or gearing. You've heard that term, I'm sure. So that's another reason they became so popular. What I want to focus on is the other thing is about how they let you choose probabilities. Because that, to me, when I first started trading on the exchange, that's what fascinated me. Because I'd always been following stocks since I was very young. But I'd watch them go up. I'd watch them go down. And sometimes I thought, oh, well, maybe this is not a good time to buy or not. I didn't know. And we never know. But when options came around and I learned that you could actually choose your probabilities, that really piqued my interest. So let's take a look at what I'm talking about probabilities. What I'm going to ask to do, if it's all right, I need to take my jacket off because it's quite warm up here. And I'm from Chicago, and I could wear this there, but it's a little warm right now. Okay, that's much better. Thank you. All right, that's as far as I go. Okay, just the coat. All right. All right. So nobody get excited back there. Okay, so let's take a look at an option chain. Now this is a real example, and we're looking at Apple. Apple, which is, let me scoop this over a little bit more so you can see it. There we go. Now here's Apple, the stock trading around $4.29. So right around $430 a share. That's an expensive stock, right? If I buy 100 shares of Apple, let me just ask you, how much money do I need? Wow, what's 42 times 100? Okay, 430 times 100. That's $43,000. I don't know about you, that's a lot of money to me. But what if I just bought an option that let me own 100 shares of Apple for whatever time period it was? Okay, well, let's take a look at what that would be. It wouldn't be $43,000, but it would still be pretty expensive. Let's take a look. So if I want the right to buy 100 shares of Apple at $430 a share, that's this number right here. We call that the strike price. So if I purchase this is the bid price. Oops, sorry, let me delete that. I don't want to create an order yet. This is the bid price, $17.70. This is the offer price, $17.85. So if I buy one of these, I will have the right to buy 100 shares of Apple at its current price, around $430 a share. Now that's still pretty expensive too, isn't it? What's $17 times 100? 1,700, right? That's 1,700. However, that's a lot less than 43,000 if I'm doing the math right. Yes, absolutely. Now, what are the odds if I buy the stock or this option that the stock's going to go up? It's the same. Because remember, the option gives you the right to buy stock at a certain price. Well, you want the stock to go higher because you want the option to buy something low, and if it goes higher, good, then you get to sell it higher and make a profit. Most people actually don't even turn their option into stock because remember, when the stock goes up, so does the value of the option. So they'll just sell the option at a higher price. It could go lower, and so would the value of the option. They both move together. But let's take a look at something about probabilities. This column right here says probability ITM. Now that's a term, don't worry about that so much. It just means what's the probability that on expiration day, which is 32 days from now, what's the probability that the stock will be, in fact, $430 a share or higher? Well, we'll tell you right now, it's pretty close. It's between 45 and 49%. That's pretty close to half, 50-50. All right? So we know that right now. What if we thought Apple was going to go much, much higher? Well, then we could buy something like Apple, let's go down here, 450 call. Now that gives me the right to buy 100 shares at $450 a share. Now if I have that right, I now have the right to buy stock at $450 a share. Well, the stock's going to have to move up $20 for me to make money, so I wouldn't be willing to pay as much for that. And sure enough, you don't. You only have to pay $10 for this one. 10 times 100, which would be $1,000, right? But now you'd really need the stock to go up before you'd make money on that option. Because remember, all of these options, no matter which strike price you choose, they all expire in 32 days. All that means is that after 32 days, you cannot turn that option into stock. Okay? You can sell the option anytime you like. You could buy it now. You could sell it in 5 minutes. You could sell it anytime between now and expiration, in 32 days. There's many, many choices you have. But I want to know in 32 days, what are the odds the stock will be where I want it to be? And this is when it gets interesting. Because when I was on the trading floor, what we looked at is saying, well, I'm not really interested in the 50-50 proposition. I could just buy the stock. That's that's not really something that interests me. So here's how we looked at it. Depending on your bias, meaning which way you think a stock is going to go, let's look at using an option in a high probability way. So for example, let's start off with Apple. And we'll use this. Let's collectively do this together. And let's say this is we're on paper money on Thinkorswim, and we're about to make our first trade. And our collective bias or opinion about which way Apple is going to be which way? Which way do you think the stock's going? Up. I heard a lot of ups. I see one down. Ups. A couple downs over here. This side's down, this side's up. Okay. All right. Well, let's do this. How many think the stock between now and, let's see, 32 days could go kind of stay where it is? Just raise your hand. Right in this range, right around 430. Okay. How many think it could go up a little, like, let's see, 430 up to about 440 or 445, something like that? Raise your hand. Okay. How many people think it could go up a lot in the next 30 days, like 430 up to 460, like $30 or $40 a share? Okay, we have one or two like that. How many think it could go down a little bit? Now it's 430 now, but I wouldn't be surprised if it went down to 420 or 410. How many people like that one? Ooh, that looks like that might be the majority. How many think it's going to go way down, like 380 or 390 in the next 30 days, and stay there? Okay, nobody likes that one. Okay. No, that's pretty common, the way to look at things. So let's think about that. So I'd say the majority of us are thinking, okay, what could I do? Let's see, the opinion here, if I had to pick, would be kind of where it is. A couple people are up a little bit and some are down a little bit. There was a contingent here. But there weren't a lot of people who thought it was going to be up a lot or down a lot. Now that's fairly typical. And what you just did is reflected the probabilities that we put in this column. You don't know how close you were to predicting the real laws of probability. So when we were in the trading pit, I think I went through this the other days, we looked at what a stock can do. Instead of just up and down, we talked about, well, let's get a little more specific. Stock could go up a lot, like we said, from 430 to 460 or 70, or up just maybe $10 or $15, or stay around where it is, within $5 where it is, or down maybe 10, 15, or 20, or down a lot, like down 30 or 40 or $50 the next 30 days. So we looked at those and we said, well, if our opinion is, let's say our opinion is that the stock is going to do, just stay right around where it is, or maybe even up a little bit. Now, some of us thought maybe it could go down a little bit, but no one really thought it would go up a lot. So let's look at it this way. If we bought the stock and it stayed right around what it is, the odds of that are about 1 out of 5, so that's about 20%. Now, if we just buy the stock outright, well, it's either going to go up or down, and it could fall in any one of the 5 categories. There's about 20% it'll fall in any one of those categories. So if our opinion is the stock's going to kind of stay where it is, or maybe slightly up or down, what if we put a position on such that we said, okay, I would like to profit on this trade if Apple just does any one of the things we think it's going to do. And let's say, just for this example, our bias was that maybe Apple was going to be slightly up, because we were kind of divided. But let's just pick, let's say your opinion was it would be slightly up. Now, I don't know in the next 35 days how much, but my opinion is it's time for the stock to start moving up, because I've done maybe some fundamental research, or I'm looking at charts, and I've decided that's my opinion or my bias. Okay, so we think it's going to be slightly up. Now, let's think about this. We could buy the stock. We got a 50-50 chance of being right. Let's look at it a different way. Now, here's how the market makers looked at it. They said, well, I don't want to do something with 50-50. I think the stock's going to be maybe slightly up in the next 30 days. So what I'm going to do is, instead of giving myself a choice here of just one of these different outcomes, like I could buy a call that will make money only if the stock goes up a lot, or I could buy a call that makes money if the stock goes up a little, et cetera, et cetera. What we're going to do is we're going to look at a put strategy. Now, this strategy is just like this. What we're going to say is that I want to start off with not 50-50, but I want to put this trade on so that I will make money on this trade if the stock goes up a lot. Okay, I'm covered, I make my money. If the stock goes up a little bit, I'm covered, I make my money. If the stock stays right where it is in the next 32 days, fine, I make my money. If I'm wrong, because remember, I think it's slightly going to go higher. If I'm wrong, and the stock goes down 10 or 15 or $20 in the next 30 days, I still make my money. Now, if I'm really wrong, and the stock goes down, like we said, $30 or $40, then I could suffer a loss. Or I will own the stock at that price. Now, how would that work? Well, this strategy is called cash secured puts. What we're going to do is with Apple at $430 a share, we're going to go much, much, much lower to the point we don't think it's going to go in the next 30 days. And what we are going to do is going to sell a put to someone. Now, don't worry how this works. All that means is you have an obligation to buy it down at that price. Now, the only reason that you would ever do this strategy is if you wanted to buy that stock at that lower discounted price. So that's what this whole strategy is all about. We're going to say, well, I want to have a very high probability that this event won't happen. But if it does, I will gladly buy the stock down at that low price. Okay? Now, let's take a look at how these probabilities work. So let's look at Apple together. All right? Let me do this. I'm going to grab my, my laser pen, because it might be easier for you to move that around so you can see in the back. So let's think about this. Apple is currently trading at $430 a share. Let's see what the likelihood is that the stock will go down to, let's pick a number. What do you think? Maybe $390? That's $40 lower than where it is now. $40 lower. So we're going to make a bet, and here's the only bet we're making, that the stock will not go down a lot in the next 40 days. That's it. Now, this is a stock we like. We think it's going higher. We'd love to be able to buy it lower. That would actually suit us just fine. But what are the odds that we'll be able to buy a $430 stock at $390 a share in the next 30 days? Okay? They're probably pretty low. Okay? Well, let's see if we can use that to our advantage. All right, here we go. Ready? Current stock, $430 a share, or approximately $430 a share. There we go. And these are the May puts over here. And let's go down to, what was our price? $390. Let's say we wouldn't mind owning 100 shares of Apple at $390. Let's just say that was our outlook. I need to square this back up so we can lower down. I need to add a few more strikes. There we go. Now, let's look at this together. 32 days until expiration of these options. The numbers are a little bit washed out for you in the back, but this is the $390 put. Now, what that means is that if we're going to sell that to someone, what that simply means is we have the obligation to buy 100 shares if Apple gets down to $390. And the only reason we're doing this is because we wouldn't mind owning this particular stock. It doesn't have to be Apple. It could be any stock that has options. Okay, that's the beauty. We're using Apple. It's something everybody knows. So let's take a quick look how that would work. So $390 a share, that's where we'd have to buy it if it went down to that price. Now, how much would we get for that? Well, it's hard for you to see right now, but that says $5.05, $5.20. Let's just round it and call it 5. So if we sell one put right here, we will collect $5 a share right now. I'll show you how it works. Here, I'll just do it on the software. I'm going to click on the $390 put. I click on it right here. And here it says, sell 1 Apple, May of 2013, $390 put, which expires in 32 days. I will collect this amount of money, $505. Now, if I hit confirm and send, I can actually show you how much money I'll make on this. I will get a check, or actually a credit in my account right now for $505 minus my $1.50. Remember, that's your commission on an option if you go ahead and take advantage of the offer that on that little sheet. That's your total commission, $1.50. So you'll actually keep $503.50. I'm selling one option. Now that money's yours, it's in your account. You can go spend it and do whatever you want. It's your money. Okay, that's credited to your account. Now, for the next 32 days, what are we going to be watching? Well, we're going to be watching where the stock goes, right? Because if it goes down to $390 and stays there, guess what we have to do? We'll buy 100 shares at $390. Okay? What I'd like to know, and like I said, in this case, we like the stock. That was our bias, so we wouldn't mind buying it at a discount. That's $40 lower than where it is now. Okay? So if we like it here at $430, how much do we like it at $390? Okay? So again, perhaps you would look at it as we're buying stock at a discount. Now, what are the odds Again, now this is where the high probability trade comes in. What's the probability the stock will get down to 390 and stay there so that we'll actually buy the stock? Anybody have a guess? I don't know. I'm going to guess maybe somewhere in the 20s. Let's take a look. Let me get rid of this. Get rid of the trade. I'm going to delete this. Let's take a look. Now look under where it says probability in the money. Go right down to that column, and what's that number right there? Can you read that? It's 22%. So you have about a 22% chance that you'll be able to buy the stock at 380. That's it. That means you have a 78% chance that you won't. So the odds are telling you right now you won't buy the stock. Almost 80%. There's an 80% chance that you will not buy the stock. Okay? It won't get down. I mean, you get your hopes up, you want to buy the stock at 390. The odds are telling you right now there's an 80% chance you will not. The stock will not go down to 390 and stay there exactly 32 days from now. So, if we sell that put, remember we still collected $500, right? So what happens if in fact the laws of probability are true, and 32 days from now, sure enough, we were right, Apple actually didn't go up a lot or down a little. Actually, it went down just a little bit. It went from 530 to 525. And now it's 32 days later. What happens? So what happens? Well, the option expires, right? So now we no longer can buy the stock at 380. The option's gone. It expires. It disappears. It doesn't exist anymore. On Monday when you wake up, on your trading platform, it will just say 0, it's gone. Now what happened to the $503? Nothing. That's yours. You kept it. Okay? And this is 32 days later. Now, let's say 32 days later, Apple is, we just said, it dropped $5. So now it's at $525. Or, sorry, $425. I'm good. Thank you for that catch. So let's say now it's 32 days later. We kept the $500. Now the stock is $425. And we still say, well, we still like the stock. I'd still like to buy it at a lower price. Let's go look at the options chain again. Now, we won't be selling May calls. We'll be selling June calls because it's 32 days later. Now, what would stop us from selling another June put at a lower level, like $385, and collecting $5 or $6 again? Now, again, we'll only have about 20% chance that we'll be able to buy the stock down at $385, but guess what happens if we don't? Well, we don't get to buy it at $385 if it's in, third week of June, but do we still get to keep the $500? Yes. Now, what if we did this month after month after month until finally one month the stock came down enough and we actually got to buy it at our price? Okay, well then, you got to buy your stock. But every month you didn't get to buy your stock, what did you do? You collected $500. That's one option. When I was standing in the trading pit, people were doing thousands of these. Warren Buffett, everyone talks about what a great stock when he purchases stock. He sells puts when he wants to buy stock. And if he doesn't get the stock, he can sell thousands and thousands of puts. So if he doesn't get the stock at his discounted price, he just keeps $1 million each month that he keeps trying to buy the stock at a lower price. We can't do that. We could sell one, maybe two, depends how much stock we want to buy. But I'll tell you, I'll take $500 a month over a stock I want to buy, even if I don't get to buy it at my price, and someone's going to pay me each month to try to buy stock at my price, and if I'm not successful to buy the stock at my price, I'll just keep the $500. Now, when someone first explained that to me, I said, well, that's impossible. How could someone walk up to you and say, okay, Apple's at $430 a share. I'm going to pay you $500 right now for you to buy the stock $40 lower? I mean, to me, that just seems completely, almost insane. I mean, why would someone do that? Why would someone come up to you and say, listen, I'd like to let you buy Apple $40 lower than it is now, and I'll pay you $500 to do it? It doesn't make sense. Well, you're only going to buy Apple at 390s if it drops down there. Now, if it gets down to 390 and you buy your 100 shares, you might be thinking a little differently about Apple, right? But still, you've now purchased it at 390. Now, what we're going to talk about in the next example is that once we own stock, how can we enhance the returns of owning that stock? That's our second subject for tonight. So the first one was, how can we buy stock at a discount? And if we don't get the stock at our price, how can we make money on a monthly basis while we're trying to buy stock at a lower price? Now again, this strategy, I must repeat, this is very important. I would only implement this strategy if I wanted to buy 100 shares. Now what if I wanted to buy 1,000 shares? Well then I'd sell 10 of them, right? I'd sell 10 of them and I'd get a check for $5,000 every month. Now the Apple, $1,000 of Apple is a lot of money. So most of us probably would not be doing that. But what about other stocks? What about Coca-Cola or GM or IBM or Google or Baidu or any of the big international companies? Yes, we can do that on every one of them. Every one of them that has options. Can't do these on the SDX stocks, unfortunately. But every other international large stock. Now, here's what's always interesting about this concept. What if you're new to investing and you say, well, listen, I'm just starting a portfolio and I'm interested in buying, diversifying, which is a very important rule for investing. I wouldn't put all my money in one stock like Apple. But we have these things called ETFs, securities, not things. They're securities. They're called exchange-traded funds. And they act just like a stock, just like this picture of Apple. They have the same options. They have calls and puts. But when you buy an ETF, you buy a share of a whole basket of stocks. For example, there is an ETF on the Dow Jones Industrial Average. Everyone heard of that? Okay, the Dow, it's 30 stocks. So actually, when you buy 100 shares of the DIA, which is the symbol, you're actually getting a portion of all 30 stocks. So really, when you buy one product, you have a very diversified portfolio. You just bought 30 of the biggest companies in the world with one purchase. Now, what if I want to buy 30 of the biggest companies in the world and have a diversified portfolio, but I don't want to pay? Well, let's take a look at what Diamond's trading for right now. Let's give you a real example. Let's jump away from Apple and look at something that's very, very popular. It's called DIA. That's one. All right? Again, no recommendation you should run out and do this, but that's trading $148 a share. Now, when you buy that, you buy 100 shares of that, you get all 30 stocks. Now, how about another one? How about one that's even more diversified? Anybody know what the name of this one is, or the symbol? SPY. That's the S&P 500. And again, if I buy that, it's trading about $158 a share. When I buy 100 shares of that, I get all 500 stocks. These are 500 of the biggest highly capitalized stocks, and it's yielding, I don't know, I guess about 2.5%, something like that. But very diversified over all the major categories and major sectors. I can do that with just buying one product. I don't have to worry about picking stocks. But let's say this is something we were looking at, and we say, well, listen, I want to diversify my portfolio, and I want to start buying something like this because it has broad exposure, but I don't want to pay $158. Well, couldn't we play the same game we just played with Apple and say, okay, it's at $158 now. I'd much rather buy it down here at, let's say $154. I'll highlight it. Okay? $154. That's like, what, 4 or 5% lower than it is now. I'd like to start accumulating some stock at that level. Okay, so we'll play the same game. Now, we're not going to sell this one for $5 like Apple. This one will get about 90 cents. Okay? So 90 cents. So if we sell one of those, you get $90. Okay? Now, what kind of return is that? Let's think about it. Well, $90 on something that's trading about 150 or 160, that's probably what, about a 0.6% or 0.7%, something like that? So even if we didn't buy it, because we kept trying to buy it at lower prices, but we kept collecting 0.7% each month, what is that at the end of the year? What's 0.7 times 12? We're making about 8%? That's not bad, okay? And we never even got to buy it. So when you look at these things, it becomes very interesting when you start considering all the different ways and that you can build and diversify a portfolio other than just one stock like Apple. Okay, again, Apple is a very expensive stock. But now we have an idea of how you can use the puts to buy something at a discount or at a lower price. And if you don't get to buy it, you just keep money that they paid you because you will be selling the put. Now, what's the second choice? What if, one of the things we talked about was defined risk. Now, remember when I said if you use this strategy, okay, what's your risk? Well, your risk is that in the case of Apple, if it went down to $390, you'd buy 100 shares of Apple. That's your risk. What's the risk of buying any stock? Well, it's the same risk as owning stock. So your risk if you sold that one put in Apple for $3.90 is that you'll own stock at $3.90, and that's the same risk as anybody else who buys stock at $3.90. Same, there's no difference. The downside is that it could go lower and you'll lose. But here's what we looked at in some of my classes, and we looked at what's another option strategy that if I did buy stock, and let's just keep using the Apple example, since we're familiar with the prices. Let's say it did go down. Finally, one month, it finally went down $40 or $50, and we bought the stock. Finally, in 30 days, it went down that much. So let's go back to Apple. Enter. Now, let's say we did buy it, and it went down to $3.90. What could we do? What's another option strategy where we can use high probability when we already own a stock? What's that? Someone said it. I heard it. Covered call, exactly. That's a perfect example. Now, in the last one, we didn't have stock. We wanted to own stock, so we used a high probability trade that even if we don't get it, we'll still make the money because we get to sell the put each month. Now, what about this strategy? Well, let's talk about another one. Let's say we did own the stock. Let's do this. Let's say that if we own the stock, and we'll use Apple. Let's say Apple started the month off and it was much higher because we'll use May. But let's create how we got here. Let's say the stock was at 470, okay? And we sold the 430 put. Now, of course, 30 days later, it went down to 430 because that's where it is now, and we bought the stock. So now we just bought the stock at 430. Okay, now we own 100 shares at 430. But that's what we want to do because remember, it was 470. It came down. We bought it at 430. Now that we own the stock, what can we do? Well, you could just hold on to the stock and hope it goes higher. That's one thing for sure, right? If it pays dividends, we'll get dividends return. That's a good yield. We call that yield. So you've got it working for you. That's another thing that's working in your favor. But that's about it. We're kind of back to the 50-50 proposition, and we hope our stock is going to appreciate. Of course we do. We want it to go higher. Plus we have the dividends coming. But what else can we do to the stock while we own it? And this is a very popular strategy, and that's why I want to bring this one up tonight as well. This is called covered calls. Now, this strategy is not like the one before where you're actually buying stock. This is that we already own stock. How can I get better returns than just the dividends and whatever the stock appreciates? How can I get consistently better returns? So this is called the covered call strategy. And here's how it works. We own the stock now at 430, right? Because we did the put strategy and we got it. I'm going to do this strategy. I'm going to say, I think Apple, of course I own it, so I think it's going higher. If I didn't, I wouldn't own it, right? But we do. So we hope it's going higher. That's our opinion. And we don't know how much is going to go in the next 30 days, but we think it's going to go higher. So let's do this. Let's go back to thinking about our probabilities, the 5 probabilities of what a stock can do. Now, we think it's going to go maybe where it is slightly higher, or maybe go slightly higher, $15 or $20 a share. That would be great if it did that in the next month. That would be fantastic. Bought it at 430, it went all the way up to 450. That would be great. Odds of that happening about 20%. Odds of it sitting right where it is, up or down a few dollars, about 20%. What are the odds that it'll drop? About $20, drop a little. About 20% as well. What are the odds it'll go way, way down? Well, again, about 20%. Well, let's look at the odds again. Let's do something that will only result in this scenario. A result that would only hurt us if it did 1 out of the 4 things again. That means it only has about a 20% chance of happening. And we own the stock. So here's what we're going to do. We own it now at 430. What we're going to do is kind of the opposite of what we did with a put. We're going to go out to someone and say, I want you to give me money that if the stock goes from 430 up to let's say 470, I want you to buy my stock in the next 30 days. Now, I own it at 430. I'm saying to someone, I want you to buy my stock for me at 470 if the stock gets up there. But I want you to pay me for it, just like the put. Now, again, that doesn't make sense. Why would someone come up to you and say, listen, Scott, I know you own stock at 100 shares of Apple, in this case, at $430 a share. I will pay you $5 a share to buy your stock from you at $470. Now, why would someone do that? Right? Why would someone do that? Well, only if they thought the stock was maybe going to go to 500 or something like that, right? Or perhaps they have some other position that they need to hedge. But we don't care. We don't care. We don't care because we own 100 shares. All we care is we're trying to enhance the value of our stock every 30 days by employing a strategy called the covered stock. So let's take a quick look at how this would work in reality. Let's look. So what is the price of the calls? Now remember, when you buy a call, that's this side, anybody who buys these calls, they have the right to buy 100 shares. So we're going to sell someone that right because we already own the stock and we own it at 430. So we're going to give them the right to, what price did we say? 470? That's $40 higher than it is now. Well, let's check it out. Here's the 470 call. Let's come over here and take a look at the price. It says $5.30. That's pretty close to our put price, remember last time? So let me highlight it so you can see exactly which call I'm talking about. It's the 470 call. Let me highlight it. It's right here. May 470 call. All right? So we own 100 shares at 430. We have 32 days to go. And we're going to go out to someone. We own it at 430. And we're going to say to them, I will give you the right to buy my stock from me at 470, $40 higher than it is now. But you have to give me right now $5, let's just call it $5 a share. It's actually a little bit more, but that's fine. So I sell him a call. I still own my stock at $430 a share. He just gave me $5 a share for the right to buy my $430 stock at $470. Now, let's think about this. What if the stock did go up to 470 in the next 32 days? What would happen? Well, the person who has the right to buy it from me now at 470, he could come to me and say, okay, Scott, give me your stock because I bought the right to take your stock away from you at 470. And I'd say, you know what, you're right. I have to honor my agreement. I give you my stock, but you must pay me 470. And he said, yes, that was the agreement. So did I just make $40 a share? Sure. It went from 430 up to 470, and he had the right to buy it, so I gave it to him. He took my stock away, and he paid me 470. So I made my $40 a share, right? Now, what about the $5 he paid me when we set this whole deal up? When I sold him the call, and he paid me $500. Do I still get to keep that? Yeah, of course, yeah. Anytime you sell a call or a put, you get that money. It's yours. Remember, it's yours. They can't take that away. That's yours. As a matter of fact, when you click sell, that money goes right into your account. You're credited. Does that make sense to everybody here? That is the concept of covered calls. So now here's Apple, where I own my stock, and of course, I want the stock to go up. But let's think about the 5 scenarios again. We own stock at 430, $430 a share. We just sold someone the right to take it away from us $40 higher, okay, but he gave me $5 a share. Now let's see, what's going to happen each month? What are the odds it will go up there and he will actually take it away? What are the odds? Does anybody know? Well, we can just look at the same chart like we did when we looked at the put. Let's look at the in-the-money probability. And it says the probability the stock will go up to 470, 32 days from now, is about 17%. 17%. Or there's an 83% chance it won't. An 83% chance the stock will not. You just did a high probability options trade. You own the stock. You're going to make a bet with someone that you will win 83% of the time. And if you're wrong, what's so bad about selling your stock $40 higher than it is now and getting an extra $5 a share? Because if that happened, what would you have to do? Well, remember, he took your stock away at 470. He paid you 470. You gladly took that. You gladly kept the $5 for the call he bought or that you sold him. But what's your inconvenience? Now you have to buy your stock back. I mean, if you still like Apple, you're going to have to go out to the market and now pay the stock. The stock's going to be above 470, right? I don't know where. It might be 475. Might even be 480. But now you're going to have to buy the stock back, and that's going to cost you $5 at Thinkorswim. At most Singapore brokers, that will cost you about $200. Thinkorswim, it's $5. So your inconvenience is you have to buy Apple again. So go ahead. Or what else could you do? Let's see how everyone's thinking. Let's say your stock did get called away at 470 and now you have no stock. What might you do? Why wouldn't you just go sell a put at 430 again? Get $5 again and hope it goes down, you buy the stock back. And if it doesn't, I'll just keep selling puts lower and keep getting $5 a share each month till I finally get the stock. And then what happens when I buy the stock? I do the covered call. Now, I hope the stock goes up when I do a covered call. Can I still lose money when I have a covered call position on? Sure, absolutely. Because remember, we own stock at 430. We're selling a call to someone, a 470 call. I'm getting $5 a share. Well, let's look at what happens. Let's say Apple goes down. In the next 32 days, Apple goes from 430 to 410. So what happened to my stock? Well, that's not good. I lost $20 a share on my stock. Went from 430 to 410. So I lost $20 on my stock. What about the $5 I got when I sold the 470 call, when I did the covered call? Do I still keep that $5 a share? Yes. So what was my net loss? 20 minus 5. So I only lost $15. But you can see that the covered call strategy is not a protective strategy. It's not something that's a hedge against your stock going lower. Because remember, whenever you own stock, you want it to go up. Now, it's not going to go up every month. Some months it'll go up a little. Some months it'll go down a little. Some months it might go up, like $15 or $20. That's great when that happens, because now your stock goes up 20 and you still get to keep the call money. Okay, then when that ends, you just sell another call at the appropriate level. But see, what we're doing is we're looking at each time, each month, if the stock doesn't go up $40, in this case, up to 470, let's say after 30 days the stock went up to 440. Okay, so we made $20 on the stock. We got to keep the $5 of the covered call. And now that the stock is at 440, we'll do the covered call again. But we won't sell the 470s this time. If the stock is at 440, we're going to go up to the 480s or 490s. You always sell the call that gives your stock enough room to appreciate during the next 30 days, right? So that's why in this case we chose something that had about a 20% chance of happening, and that gave us about $5 a share, okay? So each month, when you're doing the cover call strategy, and you get past the 30 days, and the option expires, if the stock didn't get called away, in other words, it didn't go all the way up to 470, then we start the whole process over for the next month. So now we look at the June calls, because now the stock went up to 440. So let's look at selling the call that's about 20% probability, which would probably is going to be the 480 or 485 calls, right? And now we sell that, and we just keep doing that month after month after month, and perhaps our stock gets called away, or perhaps we don't want to own the stock anymore, so we just get out of the position, we don't own the stock, we don't do the covered call. Because covered calls enhance the returns on a monthly basis. They don't protect you from a big downfall, right? Very important. It's not a hedge, it's an enhancement, okay? So what is that enhancement? Well, let's see, for Apple, stock is $400 a share, and we're getting about $5 on the call. So what percent is that? What's $4 or $5 on a $400 stock each month? That's about 1%, right? Right? Yeah, that's 1%. Now, what is that over 12 months? That's about 12%. Okay. So there it is. So if we own the stock and the stock doesn't go anywhere from now till a year later, let's say a year later from now, the stock is still at 430. We did the covered call strategy 12 months in a row, and each time we got, $4 or $5 or $6, okay, about 1% each month. Now, at the end of that year, our stock didn't go up, right? So we didn't get any appreciation. What was our return on the covered call? Well, we just said it's about 12%. In that case, that's very good. That's a very good return, because we are hoping that Apple will appreciate. So not only will we get our 12% in enhancement, but the stock will go up and we'll have some appreciation as well. Now, what does the average stock or the stock market appreciate over the last 100 years? What's the average amount that the stock market goes up each year? Well, some years it goes down, some years it goes up, but on average, what does it do? Does anybody know? It's not that much. It's like 6-7% outside of dividends, okay? That's the average amount of appreciation in the Dow Jones over the last 75 to 100 years, something right in that range. Okay, so if we can expect to get 6 or 7 or 8% by owning stocks, to me, that's not a very good proposition. I mean, we're beating inflation, of course. But what if we can add an extra 6 or 8, or in this case, 12% to that annual 6 or 7%? What is that? How much is that then annually? Well, now we're talking, 12%, 14%, 16%. Now that is a fantastic return over long periods of time. If you're able to get some sort of return in the 12 to 14 to 16%, that means you're doubling your money about, what, every 5 years. The rule of 72, if you apply that. So then it becomes very interesting, okay? So do we always want to own stocks and have covered calls? Well, the way I look at it, and many people look at it, is that I want to have covered call strategy when I do own stocks. Again, the covered call strategy is not a protection. So if the market is turning and all the signals are saying it looks like we're going into a bear market or stocks are going to be going lower for the foreseeable future, then maybe owning stocks is not a good idea. And if it's not, well, then I sure as heck won't be doing any covered calls because I don't own any stock. Okay? But perhaps I'll be looking at a put strategy. Yes, go ahead.
I just want to
Yeah.
do a scenario.
Yeah.
Let's assume that you sell a put and get the Apple at
So we sold a put, now we own Apple at 430. Okay.
The scenario is that if Apple price depreciate and
No. Yes.
bad and go all the way down.
So, yes, so Apple keeps going after we buy our stock. Okay.
Apple call nobody want to buy.
Oh, okay. So his question is, so let's say we buy, so his question is, let's say we did just what we said. The stock was at 470, came down to 430 and we bought it because we did the put.
And you, of course, you expect it to go up.
Right. So we always, of course, we only would own a stock if we expected it to go up. Okay. Or even sideways to up. Now, his question is, what if it keeps creeping lower? Let's say we do buy the stock and let's say each month it goes down $5 or $10 and it keeps doing this. Well, what will happen to us in that scenario? Well, if it starts to turn into a terrible chart pattern and everything, the market looks bad, and maybe we just want to rethink even owning stocks, okay? That's number one. So if your entire bias changes on what the direction of the market is, then maybe it's not time to own stocks. However, if it's something that kind of keeps creeping a little bit lower, at least by doing the cover call strategy, we're getting back $5 a share. So if we're losing 5 or 10, okay, it's not wiping it out. We're still getting a small amount of loss. But each time I do that covered call, what I'm doing is reducing, if you will, the cost basis of owning that stock by $5. Okay? So you're absolutely right. We have to make a decision. Do we want to continue to own the stock? Okay? Because if we're in a bear market, owning stocks is not good for anyone. Okay? So again, good point. What could happen? The stock could keep creeping lower. And in the case, we might have to make a decision. Do we want to keep owning a stock that's going lower? Obviously not. But if we're not sure that maybe it's going down for a month or 2 or 3, only to go back higher in the long run, and we still want to keep holding the stock and keep leaving room for appreciation, then the covered call strategy absolutely makes sense. Because again, you're not protecting, you're just trying to enhance the return while you own it. So you're absolutely right. So if we did the cover call strategy, and let's say the stock over the year went down 12%, that's not good. But at least during the covered call scenario, actually you still broke even. So what happens then, that means that you just now own the stock 12% lower than where it was at the beginning of the year, but you didn't make any money. But you didn't lose the 12% either. People who just own the stock outright, it's hurting them a lot more, okay, because they don't have anything to help sort of alleviate some of that down loss. Okay? So very good question, though, because that's a scenario that could certainly happen. Yes, sir? Okay, very good. So his question is, when we were talking, our first example about buying stock at a discount, his question was, am I selling a put naked? Does everybody know what that means? That doesn't mean I'm sitting behind my software with my boxers on and no, don't get any funny images. I'm not doing that. Naked means you're selling the put all by itself. And in this case, the answer is yes. And we would only sell a naked put if we wanted to own 100 shares. No, his question is exactly. Now, again, let's repeat. His question is, what if it keeps going lower? Again, once we own the stock, and it goes down to, our first example was 390, right? And we buy the stock. Now, once you buy the stock, you have all of the same risks that anybody else who owns the stock has. So you're absolutely right. If we end up buying it at 390 because goes down to that level, now we own 100 shares at 390 and we have the risks associated. So if it keeps going lower, we will lose on that stock. But again, we're buying the stock because our collective bias or opinion is that it's going to actually be going higher. Yes. Exactly. Because the stock is at 430. Yes. Well, well, anytime you own a stock, you could lose your pants. Exactly. So he's saying, well, what if we buy the stock? So it's 430 now. No, we're selling a put at 390, which means we would have to buy the stock at 390. Okay, now we'll do that because we want to own the stock. But what if he keeps going? He said, what if it goes down to $2? Well, then you lose $388 a share. Oh, okay. So his question is, okay, so let's say in the case that the first example where we sold puts to buy stock at a lower price. Now, could we get out of that put anytime? Absolutely. You don't have to hold on to your put till the last minute and then buy 100 shares of stock at 390. You can buy back your put anytime. Now, you might take a small loss on that put if you're saying, well, I don't want to own the stock at 390. Okay? It depends how close you are to expiration, okay, and where the exact stock price is. And again, that's something we can talk about later, but the concept of it, and again, remember we said we never would do this strategy of selling a put by itself, which is naked, unless we wanted to own the stock itself. Now, that brings up one other thing, is that, okay, well, his case is a very good point because if I own 100 shares of Apple at $390 a share, that's $39,000 worth of stock. Now, that's a lot of stock, and his point's very valid. Well, what if the stock keeps going lower? And he's right. If it keeps going lower, then we're going to be losing money on that stock, just like any other stock we own, we would be. But again, the put we could sell any time, but if we do get assigned, which means we buy the stock, that was the whole deal. We sold the put each month because we wanted to buy the stock at a lower price. Now, once it gets down there and you buy it, you own it. Now, what I say is that once we own it because it's stock that we still like. It might be a temporary dip, and we're taking this as a buying opportunity. Now, once we do own it, we're going to go ahead and do the covered call strategy and keep bringing more money in while we own the stock. Oh, okay, so you don't have to worry about it. So his question was, if he has a put, and he bought a put at 390 from me, he's not going to give me my stock at 390. He wants to hold on to his put and see if he can make more money on his put. Puts, you never have to deal with the person you buy or sell the option from. They're guaranteed by the exchange. So let's say, for example, Apple was at 430, our original example, and we wanted to buy it at 390 if it ever dipped down there. And let's say I bought that, I sold the 390 put to you. Now, when the Apple goes back down, I say, well, now Apple maybe went down a little bit, so I don't think I want to buy the stock after all. I'm going to buy my put back. Well, when I go buy my put back, I don't buy it back from him. I just buy it back from a big pool of put sellers. The options are what's called fungible. You never go back to the same person you bought. It's just one big pool. There's hundreds of thousands of them, okay, and they're always there. In a product like Apple or the ETFs we were talking about, they're extremely liquid, and getting in and out of a put is never a problem or a call. So you don't have to worry about that. So hold it on just a second because this question is getting a little bit deep, but we will address it afterwards. Yes? Say that again. Oh, so now we're talking about opening an account. The minimum account open, yes, $3,500. Yes. Okay, so now his next question is, if we are going to sell a put, what would happen if it got down to our price? We would buy 100 shares. Now the question here is would we need the money in our account to be able to own that stock? And the answer is, of course, yes, you must. If you don't have that money in your account, we will sell the stock for you. Okay, so but he said, no, that's a very good question because, you know, what if, let's say we had, again, we said if we do buy 100 shares of Apple at 39, he's absolutely right. We need $39,000 in our account, right? Well, if we don't have, if we had 25,000 and then we end up buying the stock, well, we're going to have to sell the stock because we don't have enough money in our account to hold it. So you always make sure, and this is one of the things that you will learn as you learn more about these strategies, is that yes, there are certain minimums you must meet to be able to do them. Now, if you're doing a stock that's maybe a $30 stock or a $40 stock, well, then you don't need nearly as much money. You don't need $3,000 or $4,000 in your account to do that. Now, Apple's an extreme example because it's a very expensive stock. Okay? If we look at something that's where most stocks are, maybe in the $40 to $50 to $60 range, then you need $4,000 or $5,000 to own 100 shares. But this is what I want to show you now, because this is brand new, just started on March 18th. What the exchange in the United States did is they looked at this exact question he just had. And they said, well, why aren't more people doing the put strategy to buy shares like Apple and Google and SPY and GLD, all these higher priced stocks? And the reason they weren't is because just what he said. If they sell the put and they do get to buy the stock at their discounted price, in our case, they still need to test in Apple, but you don't have 39,000. But you still love this concept and you'd like to get started, and perhaps you'd like to maybe just buy, I don't know, 10 shares of Apple, a tenth of that amount, so 3,900. Well, here's what we have now. Control-Alt-Delete. Hold on just a second. Here's what they just started with. I'm going to close the original chain and show you something new. They are called, now here's May, this is the normal May calls, right? They have this new thing called May Minis. Now minis are very interesting because you can see that this number 100 means it's 100 shares per contract. The mini is 10 shares per contract. Now this is brand new. Most people don't even know about this yet. So let's go ahead and open that one. May Minis. Okay, same stock. We're still looking at Apple. It's still $430 a share. We can still go down and sell the $390 put and still get $5, right? But it's going to be $5 on 10 shares, not $5 on 100 shares. So instead of getting a $500 credit when we sell it, we get a $50 credit. Now, if it goes down to $390 like he said, I will buy Apple at $390, but I'll only buy 10 shares. And I only need $3,900 in my account to do that. So now I can do what I couldn't do before. So mini options, that's exactly, his point is exactly why they did this 2 weeks ago. And they started off with just 5 stocks, the big ones. You've heard of Google, right? You've heard of Apple, Amazon. You're familiar with the company Amazon. These are all high-priced stocks that now are available. Now what they're going to do is they're going to immediately start adding this to almost all of them. But this is a brand new test program. They want to see if this is something that people want to take advantage of. And I think absolutely yes, they will, because of exactly what he said. He said, well, listen, I want to do this. I want to do this. It sounds great. I get to buy stock at a discount. I just don't have $39,000 to do it. But if I wanted to get started with a stock like Apple, this could work. I won't be making as much, but it's a start. So it's $50 a month instead of $500. But that's a good way to start. And maybe if it's a big portfolio, something like a big diversified portfolio like we talked about, like SPY, which is the S&P 500. Now it's $158 a share. But let's say I want to just get started with 10. Well, SPY also has minis. So now, for how much? $1,500, I can now have a broad diversified portfolio and do the put strategy to get started. And start off by buying at a discount. And then if I do own it, I can do the covered call strategy by selling one of the mini calls. So everything still applies that we talked about in the 2 different strategies. We're just doing it in a much smaller basis to actually start and learn and get started with a smaller amount of capital. So actually, thank you for bringing that, because that fits perfectly with what he was just saying. So very interesting concept. Now, how does this whole concept work, and how would someone get started with this? Let me just check my time. What time do we have? We're getting very close. Now, a couple disclaimers, right? Because as a professional trader, I want to make you aware of everything that can happen to you. I mean, my job as the director of education is to educate you, right? I've had 30 years of doing this. I know the pitfalls, and I know what can happen. Okay? So what do you need to know about this? Okay, well, first of all, if we do the put, selling the put all by itself, the naked put strategy, we must be prepared to own whatever it is. If it's a normal option, you must be prepared to own 100 shares. If it's a mini now, which is fantastic, now you can only own 10 shares and start much smaller. But we must be prepared, and we must have enough cash in our account to do that. Okay? That's why the mini options have opened a lot of doors for people. So on a much smaller account, you can get started. And I would suggest, though I can't tell you what to buy, if you're just starting off by building a portfolio, you want to be diversified. You're not going to be jumping out and saying, well, I'm going to buy that stock and this stock, and okay, fine, but very small. A good idea for a new investment or a new portfolio is to be diversified. So if I'm going to use this strategy of, using the naked puts to buy small increments of diversified portfolio, I would look at the ETFs like SPY and DIA. These are very broad-based investments, okay? And again, we can attempt to buy at a discount, and then once we own them, we can do the covered call strategy to enhance the return once we own them in our portfolio. Now, can you do this strategy in your Provident Fund? Does anybody know? Because I don't. I don't think so. So Thinkorswim is out to change that. So now I have my next job. I need to talk with the MAS and find out how you, in your Central Provident Fund, can do covered calls. Because that would be fantastic. You can own stocks, right? You can even own gold in your CPF, right? I think you can. All right? But why not, if you own stocks, do the covered call strategy? It's your money. Now, I don't want to create any waves here, but in the U.S. you can do that. You have what's called a self-directed Provident Fund. So what they do is they let you, and you do, you're self-directed. You have some choices of different unit trusts and things like that. You can do that. But in the U.S., they just took the next step. They said, not only are we going to let you pick your stocks in your Provident Fund, but we're going to let you start doing covered calls. So this has become very interesting in the U.S. So that now in your your retirement fund, you can enhance your returns while you own these stocks over long, long periods of time. And it makes perfect sense. Because if you're going to own stocks over a long, long period of time, that means you're not selling them, and you're not trying to buy the low and sell high. You're owning them for long, long periods of time. Well, if you're going to own stocks for a long period of time, doesn't it make sense to do the covered call strategy? Because if you ever get called out, you'll just have to buy the stock back again. So people say to me, well, Scott, I don't want to do the covered call strategy because, well, let's say Apple goes up from 420 to 460. They take my stock away, and it really went all the way to 470. So I lost that extra $10. I said, you only lost that extra $10 if you would have sold the stock at 470 because it went right back to 420 later. Well, you were never going to, that's called scalping stock. You were never going to day trade the stock in the first place. You're holding it for a long, long time, and maybe till retirement. So I don't really, I left some money on the table. It doesn't really mean much to me. A month from now, 6 months from now, it could be $30 lower. Okay? So again, and it really does make sense in a long-term period. So now what are the other pitfalls? Well, number one, we have to have enough money in our account to own the stock when we do the naked put or the cash covered put strategy. We'll have all the risks involved with owning a stock. We must have sufficient capital. Okay? We also must know what to do, what happens when we get, if the stock does go up when we do the covered call strategy, because they could take our stock away. Okay? In which case, you're right, we actually would have to buy our stock back because it's gone now. Okay? That's what happens when it goes up to your price. So there are some things you need to think about. Okay? Now, so what I'm going to do is I've left you with some very basic strategies. And these are very popular strategies in the U.S., and they're becoming more popular since people could start doing them in their Provident funds as well. So people are now learning about options, and they're learning about the probabilities with options, and they're applying them to these, for example, 2 simple strategies. Okay? But again, there are things you have to pay attention to. There's something else you need to learn about calls and puts, particularly calls, is that when you sell a call, let's say the stock goes up to that level. So we had stock at 430, and let's say it goes up to 470, but it goes up there before the 32 days. So in other words, let's say there's still 3 or 4 days left for the option, but now the stock has gone above that price already. What could happen? Well, you sold a call to someone, and they have the right to take your stock away. Now, they can do it any time. If they don't do it, on the last day, it will be done for them automatically. On the last day, when the bell rings and the market closes, your stock gets taken away automatically. It's all done for you electronically. But they don't have to wait till the last day. They can do it a day before, or 2 days before, or 3 days before. But any time after the stock goes above 470, they can actually take it away from you. Okay, so you have to be prepared for that. And again, all that simply means is they'll take your stock away earlier than later, which I find is actually a good thing because that lets me buy the stock back earlier instead of having to wait. And if the stock keeps going up, that's less that I have to buy it back at a higher price later, right? So again, there's little things you want to learn. Those are called assignments and exercise. So in this strategy, again, if you're prepared for those two things that we just talked about, and you learn a little bit more about options, this is something that, you know, I think anybody in a long-term portfolio could be doing and learning about with a little guidance and learning a little bit more about how to do them, okay? Outside of that, if you'd like to obviously learn more about this is the kinds of things that we'll look at the Thinkorswim software and on a demo account and have some fun and talk about the different strategies and how to execute them. Now, the first two I just talked about tonight are, like I said, are fairly simple strategies. The covered call strategy is probably one of the least risk strategies because you already own the stock, okay? So again, the enhancement strategy, not too risky. The put strategy, well, you have all the risks with, if it does go down to your price and you buy the stock, you have all the risks associated with owning stock. And if you're comfortable with that, what a great way to buy a stock at a discount. And if you do buy it, turn around and start getting better returns while you own it. Now, can I do this strategy on a stock that doesn't have options? Well, no. The stock must have an option chain or I won't be able to do it. On the Thinkorswim software, we show you all the different stocks that are optionable, so you'll always see that. And we have a list of stocks that we call penny increment stocks. So when it comes time to selling your options, your calls and puts and whatever strategies you're using, you always want to use something liquid. Liquid means that there's lots of people, there's lots of bids and lots of offers, and it's easy to get in and easy to get out at a reasonable, fair price. Okay? And again, we talk more about that in the other classes, the intermediate classes and advanced class as well. Okay? So if you're interested in learning more about this strategy, and what we'll do in the intermediate class and advanced classes, we look at different examples. Like I said before, there are certain times we'll actually use the paper money account and we'll put these trades on. So I force people, I say, you have homework. As a matter of fact, our homework, I will show you a homework right now. All right, let's see if we have one in here. Here's one. Monitor page. Not this position. Option buying. Let's go here and look at another account. Right here. Here it is. Apple. Sold one. Apple 410 put. Here's the date. Sold one Apple 410 put. Now this one didn't have much time left, and it was for $2.64. That's $264. Sold it at $2.64. Current price is 77 cents. And now, so it has a profit of about $187 right now. Okay? Now, when does that one expire? Let's go back to the trade page, and let's take a look. This is the option right here. So when I open April, it shows me. That's the one right there. That's the put. Let me highlight it. So we sold that put at $2.60. What was it again? $2.64. Collected $264. Now it's down to about 76 cents, so it's up about 100 and something dollars. But you can see that's how it works. So in paper money, we'll do positions like this. And now this has 4 days till expiration. Now let's say Apple stays above, what's the strike we sold? 410. Let's say Apple stays above 410 the next 4 days. What happens to this put? Expires. And what's the price going to be on the last day? 0. So that would simply mean that you keep all $267 or whatever it was, minus your $1.50 commission. Okay? So this is the kind of thing. We'll do this in paper money. We'll do trades each month. We'll look at using the Thinkorswim software and go through the process together. So it becomes very interesting because what I want to do is, as you're doing these things in paper and demo accounts, there's no better way to learn how to implement a strategy than to actually do it. Okay? Again, I am not saying to go run home and do this in your live account right now. I'm not saying that. I'm saying if you want to learn how and get some hands-on experience on how to do this, and my rate's pretty reasonable. I don't charge much for my classes. All right? Did I tell everybody what the price was? 0. I'm not selling a product. I'm sharing my information, what I learned as a professional trader for 30 years. And that's one of the nice things about Thinkorswim. I mean, people say, well, why would I use Thinkorswim? Why can't I use another discount broker? You guys are all about the same price. And I say, no, actually our stock price is much lower than anyone else. But this is what we provide. Other brokers who aren't even here or aren't registered with the MAS, they don't do anything like this. And if they did, they'd probably charge for it anyway. Or they'd have some person there trying to sell you something, right? We don't do that. Okay, so if you want to learn more and learn about these strategies and other strategies, come to my class. Okay, if you register with Thinkorswim, you can come to my classes. We hold them every Tuesday and Thursday night, and we rotate basic, intermediate, advanced, basic, intermediate, advanced. They just keep rotating. So your class, if you're in the intermediate level and we're learning more strategies like this, then and seeing how to use the Thinkorswim software to implement those strategies, then you'll be meeting me about every week and a half. Okay. And you have to do your homework because I stop letting people in the room if they don't do their homework. Okay? So if you don't participate and put the trades on, you can't come to the class anymore. Okay? Because so many people would say, oh, Scott, that's great, and they watch me do it, and then they wouldn't do it. And you who are laughing, you know who you are. So I'm really going to implement that rule. So listen, folks, it's already 9 o'clock. I'm going to let everybody go. If you have more questions, I'll be around here for a few minutes. Hopefully you've got a little bit more interest in options. You'd like to learn more, and you will come to some classes, and I will see you again sometime. All right? Thank you, folks, for coming. Everybody have fun, drive safely, and take care. And good luck trading.